Well, if there is one issue that will define the election next year, it is the economy. The heady highs of government wage subsidies and cheap borrowing during COVID are over, and the come down could be brutal as storm clouds gather internationally. So with me now to discuss is our special economy panel, Bernard Hickey, editor of kaka.substack.com, welcome, and Christina Leung, principal economist at NZIER, welcome to you both. Listen, I just want to start, I suppose, with a bit of a sense set. It is really tough out there at the moment for people, isn't it, Bernard?
Well, it feels tough because prices are rising. For those people who own property, they're seeing their prices fall. But actually, when you look at it in the wide sweep of history, the key thing to know is 3.2 or 3% unemployment. That's incredibly low, and anyone who wants a job has got one. And when you look at household incomes, they're rising at the moment as fast as prices. So actually, the real wage shock that everyone's talking about, it's not quite as great as everyone thinks. I actually think the last 2 or 3 years of COVID and war and a whole bunch of things has made us grumpier than we actually are. And if you look at how much we're spending and how much we're earning, we're actually doing a lot better than we say we feel.
Yes, and I want to talk about that sort of sentiment and employment as well. Christina, I was talking to Consumer New Zealand yesterday. They do a sentiment survey among New Zealanders. They found 10% of people are going into debt to make ends meet each month, and 50% of Kiwis right now aren't saving. That is a big turnaround from just 12 months ago, isn't it? That's the impact, I suppose, of...
Yeah, so if you look at, and Bernard is right, we do have a very strong labour market, and that is providing some buffer to the economy. That said, though, we look at the latest Stats NZ Household Living Costs Index, and that does show that living costs are rising at 7.7% over the past year, driven by high prices for food and housing. So it's these things, particularly for the low income, it's because it makes such a larger basket of their consumption basket, it's much harder to avoid for them, and that is where that pain is really hitting.
Is it? Sorry, Bernard?
And in a way, we have an economy and society bifurcated into two groups. Anyone who owns a home and anyone who doesn't own a home. Those people who are renting are probably on lower incomes and then have higher rents, and they haven't got the buffer now of higher asset values and savings in the bank. Because actually, when you look at the household sector and how well off it is, $1.8 trillion it's worth, and quite a bit up from the beginning of COVID. The difference, though, is that's all about home ownership and assets. Those people who don't have assets in home ownership are the ones who are really feeling the pain.
Absolutely, and that was reflected in the Consumer New Zealand survey too. They said Kiwis' top financial concern is making rent or mortgage payments. And food was also up there right now at the top of the list, when 12 months ago it was at 8. So that's what we're feeling at the moment, isn't it?
Yeah, and certainly when you look at like the consumer, the CPI, where you have food prices going up almost 14% over the past year. Again, just the fact that it's these price of necessities, which particularly for lower income, it's a lot harder to avoid having to pay these high prices.
In terms of inflation, Grant Robertson said this week that it has peaked. Do we believe that? I'll start with you, Bernard.
Brave call from him, because there's a few people who've said it's about to peak and then it hasn't really. We'll know in the next 6 months or so. All of the leading indicators you're seeing globally, things like shipping container costs, and even just in the last couple of days, wage inflation in the likes of the United States are starting to come over the top and head down the other side. It's just whether it's fast enough to convince the central banks to stop hiking interest rates, because at the moment the central banks are in pure credibility recovery mode. It's all about, we got it wrong last year and we better show you that we're really serious about inflation, so we're going to hike rates until the pips squeak. And even though they know that whatever they do now doesn't really take effect for a year or two, and in a year or two inflation could be quite a bit lower, and the risk is they over-tighten, and we'll see whether that happens.
Yeah, Christina, do you think that we have peaked?
So if we look at, for example, the NZIER quarterly survey of business opinion, certainly the inflation indicators show some moderation, and it does suggest that the trend is moving down. Again, as Bernard says, it's just how fast it is. Is it fast enough for the Reserve Bank to be comfortable that it's done enough to bring the inflation back towards its inflation target band of 1 to 3%? At the moment, just given where with the latest CPI showing that annual inflation is at 7.2%, it does suggest that there's still some tightening to go to to dampen that demand back to where supply constraints are in order to rein in inflation. To the point about the lag in the impact of rising interest rates, it is very true, particularly with the fact that 12% of mortgages in New Zealand only are on floating, and we've got around 45% of mortgages that are fixed that's to be repriced over the coming year. So we're talking about these households that are moving from historically low fixed mortgage rates of 2 to 3% to something over 5%. Now, this increase in mortgage repayments, that will mean quite a significant adjustment in spending for many of these households over the coming year.
And it's particularly dangerous for the government because come just before Christmas, the Reserve Bank is expected to put up interest rates again, and it could be a super bazooka, a 75 basis point hike, and then interest rates stay high, and as Christina says, the rollover effect comes through into next year just before the election. So for the government, the timing is really bad. Inflation might only just be starting to fall, but that's when people with mortgages are really feeling the pain coming through.
It is politically precarious for them, isn't it? We are seeing mortgage rates at over 7% in the US at the moment. Is that where we're heading? At the moment, I think it's around 5.99 for a one-year fixed. Some of the longer-term ones are creeping over 7, but are we set for a sort of those hikes to be reflected in the interest rates?
So given how high the recent inflation data came out at, there is definitely that increasing talk that the Reserve Bank will have to go a lot, do more and have interest rates for higher. The fact that with expectations of OCR reaching around 5%, potentially even above that, it's entirely possible that mortgage rates will go to 7% and over that as well.
I want to talk a little bit about the Reserve Bank's role because we've sort of started talking about that here, but is it better? Is higher inflation better than higher unemployment? These are the things that it's balancing, isn't it?
So, of course, there are costs and benefits. Why inflation matters for the Reserve Bank to be keeping it low is that at the end of the day, high inflation penalises savers. So if you have savings and you have high inflation, you're going to see the purchasing power of those savings being eroded away quite quickly, like the greater the inflation is. So that's why also the fact that with menu costs, I'm sure, like the fact that with prices rising so quickly, then people were constantly having to adjust prices. That makes planning that much harder, not knowing that whatever you commit to longer term, it actually might cost a lot more down the track.
And so I suppose